Let me ask you something that might change how you think about your retirement portfolio forever. If you knew a market crash was coming tomorrow, not if, but when, you achieve something that your investments could survive it, would you be able to sleep at night knowing your life savings were protected? Most people over 65 cannot answer yes to that question. And that terrifies me because I have seen what happens when retirees are caught unprepared. I have watched people lose 40% of their portfolios in a matter of months. I have seen retirement dreams shattered because someone owned the wrong stocks at the wrong time. I have witnessed couples who worked their entire lives suddenly unable to afford their medical bills, their grandchildren's education, their basic dignity in their final years. And the tragedy is that almost all of it was preventable. You see, there is a fundamental difference between stocks that make you money in good times and stocks that protect your money in bad times. Most investors, even experienced ones, do not understand this distinction. They chase returns, they buy whatever is going up. They listen to television personalities who have never managed real money through a real crisis. And when the crash comes, and it always comes, they are devastated. But here's what I have learned over 9 decades of investing. There are certain businesses, certain stocks that are almost impervious to economic chaos. Companies so essential, so dominant, so financially fortress, like that they not only survive crashes, but often emerge stronger. These are the stocks I own. These are the stocks I have held through 14 major market downturns. And these are the only 4 stocks I would recommend to anyone over 65 who wants to protect their wealth while still earning reasonable returns. Let me take you back to 1974. I was 44 years old running Berkshire Hathaway, and the market was in absolute free fall. The S&P 500 dropped 48% from its peak. Inflation was raging at 12%. Unemployment was surging. The newspapers were filled with predictions of economic collapse. People were genuinely afraid that capitalism itself might be ending. I remember sitting in my office in Omaha looking at the carnage around me. Companies I had followed for years were trading at prices that made no sense. Good businesses, profitable businesses, were being sold for less than the cash sitting in their bank accounts. And do you know what I did? I bought aggressively. I bought when everyone else was selling. But here's the critical part that most people miss. I did not buy just any stocks that were down. I bought specific types of businesses, businesses with characteristics that I knew would allow them to survive and eventually thrive, businesses that could raise prices during inflation, businesses that people needed regardless of economic conditions, businesses with so much financial strength that they could weather any storm. And those purchases made during one of the worst market environments in American history became the foundation of much of my wealth. The stocks I bought in 1974 and 1975 generated returns that changed my life and the lives of my shareholders, but only because I understood what makes a stock truly crash-proof. Now I want to share that understanding with you, because if you are over 65, you do not have the luxury of waiting 20 years for your portfolio to recover from a bad decision. You need to get this right the first time. You need stocks that will protect your capital when markets fall, pay you consistent income while you wait, and still give you reasonable growth over time. That is a demanding set of requirements. But I have found exactly 4 stocks that meet all of them. Before I reveal these 4 companies, let me explain what I look for in a crash-proof investment, because if you understand the principles, you can evaluate any stock on your own. You will not need me or anyone else to tell you what to buy. The first characteristic is what I call essential demand. The company must sell something that people need regardless of economic conditions. When times get tough, consumers cut back on luxuries. They delay buying new cars. They skip vacations. They cancel subscriptions. But they do not stop buying food. They do not stop taking their medications. They do not stop using electricity or brushing their teeth. A crash-proof stock sells products or services that are immune to economic cycles because people simply cannot live without them. The second characteristic is pricing power. During a crash, Many companies are forced to cut prices to attract customers. This destroys their profits and often their viability. But some companies can actually raise prices during recessions because their products are so essential and their brands are so strong that customers will pay whatever is asked. This pricing power is like a shield that protects the company from the worst effects of economic downturns. The third characteristic is financial fortress. A crash-proof company must have a bulletproof balance sheet. Low debt, high cash reserves, strong credit ratings. When the economy contracts, credit markets freeze. Weak companies cannot borrow money to survive. But strong companies not only survive, they often go on offense, buying competitors at fire sale prices. The best crash-proof stocks are actually strengthened by crashes because they can acquire assets and market share while others struggle. The fourth characteristic is dividend durability. For someone over 65, income is critical. You need stocks that will keep paying dividends even when the market is falling apart. This means looking at dividend history. Has the company paid dividends through previous recessions? Has it maintained or even increased those dividends during tough times? A stock that cuts its dividend during a crash forces you to sell at the worst possible moment. A stock that maintains its dividend lets you hold on and wait for recovery. The fifth and final characteristic is competitive moat. The company must have something that protects it from competition. A brand so powerful that customers are loyal, a distribution network so vast that competitors cannot replicate it. Patents or intellectual property that create barriers, network effects that make the product more valuable as more people use it without a moat. Even a great business can be destroyed by competition during a downturn when customers are price sensitive. These 5 characteristics are my filter, and when I apply them rigorously, only a handful of stocks pass. Today I am going to share the 4 that I believe every investor over 65 should consider owning. The first stock is Procter & Gamble. Now I know some of you might be surprised that I am starting with a company that Berkshire does not currently hold in large quantities, but I am not here to promote my portfolio. I am here to share what I believe are the best crash-proof investments for retirees. And Procter & Gamble exemplifies everything I look for. Think about what this company sells. Tide laundry detergent, Pampers diapers, Gillette razors, Crest toothpaste, Charmin toilet paper, Bounty paper towels. These are not luxury items. These are not things people stop buying when the economy weakens. In fact, during recessions, people often spend more time at home, which means more loads of laundry, more home-cooked meals, more cleaning. Procter & Gamble sells the products that make daily life possible. The company has been around since 1837, 188 years of continuous operation. It has survived the Civil War, 2 world wars, the Great Depression, the financial crisis of 2008, and the pandemic of 2020. And through all of that, it has not only survived but thrived. That kind of longevity tells you something profound about the durability of this business. Let me give you some numbers that illustrate why this stock is crash. Procter & Gamble has increased its dividend for 68 consecutive years. 68 years without a cut, through every recession, every market crash, every economic crisis over nearly 7 decades. This company has mailed bigger checks to its shareholders every single year. That is not just impressive. That is almost unique in American business. During the financial crisis of 2008 and 2009, when the S&P 500 fell 57% from peak to trough, Procter & Gamble stock fell about 35%. Still painful, but far less than the market. And that dividend, it increased by 11% during the crisis, while other companies were slashing payments and laying off workers. Procter & Gamble was raising its dividend and maintaining its workforce. The company has pricing power that most businesses can only dream of. When input costs rise, when inflation hits, Procter & Gamble raises prices. And customers pay because switching to a generic alternative feels like a downgrade. There is an emotional connection to these brands that goes beyond rational calculation. Parents feel better buying Pampers for their babies. People feel cleaner using Tide. This brand loyalty translates directly into pricing power. The balance sheet is rock solid. The company generates around $18 billion in free cash flow annually. It has moderate debt levels and a AA- credit rating, which is investment grade. And then this company could stop all sales tomorrow and survive for years on its cash reserves and borrowing capacity. That is the definition of financial fortress. For a retiree, Procter & Gamble offers a current dividend yield of around 2.5% to 3%, depending on the stock price. That is meaningful income. And because the dividend has grown historically at around 5% to 6% annually, your income keeps up with inflation over time. $1,000 invested today might generate $30 in dividends this year, but 10 years from now, that same investment could be generating $50 or more without you adding a single dollar. Let me tell you a story that illustrates why this kind of stability matters so much. In 2008, I met a retired schoolteacher named Margaret at one of our shareholder meetings. She had built her entire retirement portfolio around dividend, paying consumer staple stocks, including Procter & Gamble. When the market crashed and her neighbors were panicking, she told me she slept soundly every night. Why? Because her dividend income actually went up during the crisis. She did not have to sell a single share. She did not have to change her lifestyle. She just kept collecting her checks and living her life while everyone around her was in turmoil. That story has stayed with me because it illustrates the real purpose of crash-proof investing. It is not about maximizing returns. It is about maintaining your quality of life regardless of what markets do. It is about having the confidence that comes from owning businesses that perform through any environment. This is the kind of boring, reliable, sleep well at night stock that belongs in every retiree portfolio. It will not make you rich quickly. It will not double in a year, but it will be there, paying you, protecting you, decade after decade. And when the next crash comes, while other investors are panicking and selling at losses, you will be collecting your dividend check and waiting patiently for recovery. The second stock is Apple, and I am going to tell you why this might be the single best crash-proof investment available today. Even though it does not look like a traditional defensive stock, I will admit that Apple surprised me for most of my career. I avoided technology companies because I did not understand them well enough to predict their futures. Technology changes so fast that today's leader can become tomorrow's also. I watched Kodak collapse. I watched Nokia disappear. I watched BlackBerry fade into irrelevance. These were dominant companies that seemed invincible until they were not. But Apple is different. Apple is not really a technology company in the traditional sense. It is a consumer products company that happens to use technology. It is a luxury brand that has achieved something no other technology company has ever accomplished. It has created an ecosystem so sticky, so integrated, so essential to daily life that customers cannot leave. Think about what happens when you buy an iPhone. You do not just buy a phone, you buy into an entire way of living. Your photos go to iCloud, your music is on Apple Music, your watch syncs with your phone, your earbuds connect seamlessly, your laptop shares your messages and calls, your credit card lives in Apple Pay, your health data is tracked and stored. Every piece of the puzzle fits together so perfectly that switching to Android means losing access to years of your digital life. This is not technology dependency. This is ecosystem lock-in, and it is one of the strongest competitive moats I have ever seen. During the pandemic crash of 2020, when markets fell 34% in about a month, Apple recovered faster than almost any large company. Why? Because people still needed their phones. They still needed their computers for remote work. They still needed their tablets for their children's schooling. Demand for Apple products did not collapse during the crisis. If anything, it accelerated. But here is what really makes Apple crash. proof for retirees, the services business. Most people think of Apple as a company that sells hardware, phones, computers, watches, earbuds, and yes, that is a huge part of the business. But over the past decade, Apple has built a services empire that generates over $90 billion in annual revenue. This includes the App Store, where Apple takes up to 30% of every transaction, iCloud storage subscriptions that renew automatically every month, Apple Music subscriptions, Apple Television Plus subscriptions, Apple Arcade for games, Apple Fitness for workouts, Apple Pay fees from every transaction, Apple Care warranties, and soon, probably financial services, healthcare integrations, and who knows what else. This services revenue is recurring, predictable, high margin, and growing faster than hardware. It is the kind of revenue that keeps flowing even when people delay buying a new phone. Even during a recession, people do not cancel their iCloud storage. They do not delete their music libraries. They do not stop using Apple Pay. The services business provides a floor under Apple's revenue that did not exist a decade ago. Apple also returns enormous amounts of cash to shareholders. The company has bought back over $600 billion worth of its own stock since 2012. That is more than the market value of most companies. These buybacks reduce the number of shares outstanding, which increases earnings per share even when total earnings are flat. It is like the company is constantly giving you a raise without you doing anything. The dividend is not as high as Procter & Gamble, yielding around 0.5% currently. But Apple has increased its dividend every year since it started paying one in 2012. And given the massive cash generation, there is enormous room for that dividend to grow. Some analysts believe Apple could eventually pay a dividend yield of 2 or 3% while still buying back billions in stock. For a retiree concerned about crashes, Apple offers something precious. Growth potential combined with defensive characteristics. You get exposure to the world's most valuable company, one that is likely to be even more dominant a decade from now. But you also get a balance sheet with over $60 billion in net cash, a services business that provides recurring revenue, and a customer base so loyal that economic conditions barely affect purchasing decisions. I own more Apple stock than any other position in the Berkshire portfolio. That is not an accident. That is conviction based on understanding this business deeply. And I would be comfortable owning it for the next 50 years if I live that long. There is something else about Apple that makes it particularly attractive for retirees. The management team understands capital allocation at a level that few companies match. Tim Cook has been ruthlessly efficient with shareholder capital. Every dollar that Apple does not need for operations or investment gets returned to shareholders through dividends and buybacks. There is no empire building. There is no wasteful acquisition spree. Just steady, disciplined return of capital to the people who own the company. I have also been impressed by Apple's ability to expand into new categories while maintaining its premium positioning. The Apple Watch has become the most successful watch product in history. AirPods dominate the wireless earbuds category. Apple's services business did not exist a decade ago and now generates nearly $100 billion in revenue. This kind of innovation while maintaining discipline is extremely rare. Most companies either stop innovating or lose their financial discipline. Apple does neither. The third stock is Coca-Cola. I have owned Coca-Cola since 1988. That is 37 years of holding the same stock through multiple recessions, market crashes, management changes, and competitive threats. And I have not sold a single share. Do you know what my original investment of about $1 billion is worth today? Approximately $25 billion. And that does not include the billions in dividends I have received along the way. In fact, Berkshire now receives over $700 million per year in dividend payments from Coca-Cola. Our annual dividend income is approaching our original purchase price. But I did not buy Coca-Cola because I thought it would make me rich. I bought it because I recognize that this company has characteristics that make it nearly indestructible. And those characteristics have only strengthened over the decades. Coca-Cola does not sell soda. Coca-Cola sells happiness in a bottle. That sounds like marketing speak, but it is profoundly true when someone reaches for a Coca-Cola. They are not making a rational calculation about sugar content or cost per ounce. They are reaching for a feeling, a memory of childhood, a sense of refreshment and pleasure, an emotional connection that transcends logic. This emotional connection is the most powerful competitive moat in business. You cannot replicate it. You cannot buy it. You cannot disrupt it with technology. Pepsi has been trying for 100 years and has never succeeded. Store brands sell cola for half the price, and people still choose Coca-Cola. That is brand power so strong it defies economic analysis. During the Great Depression, Coca-Cola sales actually increased. Think about that. The worst economic crisis in American history, and people were buying more Coca-Cola because even when money was tight, people needed small pleasures. They needed something to look forward to. A 5-cent bottle of Coke was affordable joy during impossible times. The same pattern repeated in 2008. While the financial system was collapsing, while unemployment was surging, while home values were plummeting, Coca-Cola kept selling products and raising dividends. The stock fell along with everything else, but the underlying business barely blinked. And that is what you want in a crash-proof stock. A business that keeps operating, keeps generating cash, keeps paying dividends, regardless of what the economy is doing. Coca-Cola has increased its dividend for 62 consecutive years, longer than most people have been alive. Through every recession, every war, every crisis, over 6 decades, the company has raised its payment to shareholders for a retiree who needs dependable income. This track record is priceless, with high confidence that the check will arrive. It will probably be bigger than last year. That reliability lets you plan your life. But I want to address the criticism that Coca-Cola is a dying company because people are drinking less soda. This narrative has been around for decades, and it misunderstands what Coca-Cola actually is. Coca-Cola is not a soda company. Coca-Cola is a beverage company that owns the number 1 or number 2 brand in almost every drink category. They own Minute Maid juices. They own Dasani and Smartwater. They own Costa Coffee, one of the largest coffee chains in the world. They own Honest Tea. They own Fairlife Milk. They own energy drinks and sports drinks and sparkling water and everything in between. When consumers shift from soda to healthier alternatives, they often shift to another Coca-Cola product. The company does not lose. It just redirects you within its portfolio. The financial position is exceptional. Coca-Cola generates over $10 billion in free cash flow annually. The balance sheet is conservative, the credit rating is investment grade, and the dividend payout ratio, while high, is sustainable given the steady cash generation. This is a company that can maintain and grow its dividend for decades to come without stretching its finances. I want to share something that most investors do not appreciate about Coca-Cola's business model. The company does not actually make most of the beverages you drink. Coca-Cola produces concentrate, the secret formula, and sells it to independent bottlers around the world. These bottlers handle the capital-intensive work of production and distribution. Coca-Cola captures the highest margin part of the value chain while pushing the lower margin, higher capital intensity parts to partners. This is brilliant business design. It means Coca-Cola can generate enormous cash flow relative to the capital it needs to reinvest. The return on invested capital is extraordinary because the capital requirements are minimal, and it means Coca-Cola's profits are somewhat insulated from cost inflation in manufacturing and distribution. The bottlers absorb much of that volatility while Coca-Cola focuses on what it does best, which is building and maintaining the world's most valuable brand. For someone over 65, Coca-Cola offers a current yield of around 3% with consistent dividend growth. It offers downside protection during crashes because the business is so stable. And it offers peace of mind because you are owning a piece of one of the most recognizable brands in human history. 139 years of history present in over 200 countries, selling 2 billion servings every single day. That is not going away. The fourth and final stock is Johnson & Johnson. This company represents perhaps the purest form of crash-proof investing because its products are not just wanted, they are needed for survival. Johnson & Johnson operates in 3 segments: pharmaceuticals, medical devices, and consumer health products. Actually, they recently spun off the consumer health business into a separate company called Kenvue, but the remaining pharmaceutical and medical device businesses are even more crash-proof than before. Think about what happens during a recession. People might delay buying a new car, they might skip their vacation, they might eat at home instead of restaurants, but they do not stop taking their cancer medications. They do not skip their heart surgery. They do not postpone their knee replacement indefinitely. Healthcare is the ultimate essential spending. Johnson & Johnson makes drugs that treat some of the most serious conditions on earth: cancer, autoimmune diseases, infectious diseases, mental health disorders. These medications are not optional for the patients who take them. They are lifelines. And that means Johnson & Johnson's revenue is remarkably stable regardless of economic conditions. The medical devices business is similarly resilient: surgical instruments, orthopedic implants, contact lenses. These products are needed by hospitals and patients, regardless of whether the stock market is up or down. In fact, healthcare spending in America has increased every single year for decades, through every recession and recovery. The demographics alone guarantee continued demand as the population ages. Johnson & Johnson has increased its dividend for 62 consecutive years, same as Coca-Cola for over 6 decades. Through every economic challenge, this company has raised its payment to shareholders. That kind of consistency does not happen by accident. It happens because the underlying business generates cash reliably year after year. The balance sheet is legendary. Johnson & Johnson is one of only 2 companies in America with a AAA credit rating, the highest possible. The other is Microsoft. That credit rating means Johnson & Johnson can borrow money at rates usually reserved for governments. It means the company has essentially zero risk of financial distress. It means your investment is as safe as corporate equity can possibly be. During the 2008 financial crisis, Johnson & Johnson stock fell about 30% from peak to trough, painful, but far less than the market's 57% decline. And the dividend, it increased by 10% during the crisis year. While banks were failing and automakers were being bailed out, Johnson & Johnson was raising its dividend like nothing was happening, because for their business, nothing really was happening. People still needed medications. Hospitals still needed supplies. The current dividend yield is around 3%, which is meaningful income for retirees. And given the 60-plus year track record of increases, you can be confident that income will grow over time. $1,000 invested today generates about $30 annually. In 10 years, it might generate $45 or $50 in 20 years, who knows, $75 or $100 from that same original investment. That is the power of dividend growth compounding over time. Now let me pull all of this together and explain why these 4 stocks specifically form such a powerful crash. Proof portfolio first. They provide diversification across different sectors. Procter & Gamble is consumer staples. Apple is technology, though, really consumer products. Coca-Cola is beverages. Johnson & Johnson is healthcare. These sectors have different characteristics and tend to perform differently under various economic conditions. But all 4 are defensive in nature, meaning they hold up better than average during market downturns. Second, they provide layered dividend income. The combined yield of these 4 stocks, equally weighted, would be somewhere around 2 to 2.5%. That is meaningful income. And because all 4 have long track records of dividend growth, that income will increase over time without you doing anything. You are building a growing income stream that fights inflation naturally. Third, they provide different growth profiles Apple offers higher growth potential with moderate income. Coca-Cola and Johnson offer moderate growth with higher income. Procter & Gamble offers steady, predictable performance together. You get a balanced approach that does not rely entirely on any single outcome. Fourth, and most importantly, they provide crash protection through fundamental business quality. Every one of these companies has survived multiple recessions and market crashes. Everyone has maintained or increased dividends during crisis periods. Everyone has the balance sheet strength to weather extended downturns. Everyone sells products or services that people need regardless of economic conditions. Let me give you a historical perspective that illustrates this crash protection. During the 2008 financial crisis, a portfolio equally split between these four stocks would have fallen approximately 32% from peak to trough. Still painful, still scary, but the S&P 500 fell 57% during the same period. That is a massive difference. More importantly, the dividend income from this portfolio would have continued uninterrupted, while other investors were selling stocks at losses to fund their retirements. You would have been collecting dividend checks and reinvesting them at depressed prices. By the time the market recovered, your portfolio would have recovered faster because you were accumulating more shares during the downturn. This is the real advantage of crash-proof stocks for retirees. It is not just that they fall less during crashes, though they do. It is that they allow you to avoid the catastrophic mistake of selling at the bottom. When your income keeps flowing, when your companies keep operating, you can afford to be patient. You can afford to wait for recovery. You do not have to crystallize losses at the worst possible moment. Let me tell you how I would think about implementing this strategy. If I were starting over at 65 first, I would build positions gradually. Do not put all your money into these stocks on a single day. Markets fluctuate, prices change. By investing over time, perhaps over 6 to 12 months, you smooth out the entry price and reduce the risk of buying at a temporary peak second. I would weight the positions based on my income needs. If you need more current income, tilt toward Coca-Cola and Johnson with their higher yields. If you can afford to wait for income growth, tilt toward Apple with its lower current yield but higher growth potential. There is no single right answer. It depends on your personal situation. Third, I would hold these stocks in tax-advantaged accounts if possible. IRAs and similar accounts allow dividends to compound without annual tax drag. Over decades, this tax advantage can be worth hundreds of thousands of dollars. It is one of the most valuable benefits available to investors, and too many people do not take full advantage of it. Fourth, I would reinvest dividends during accumulation phase and switch to taking income when needed. When you are building your portfolio, let those dividends buy more shares. The compounding effect is powerful, but when you need income to live on, switch to taking the cash. That is what the dividends are for. There is no shame in spending your investment income. That is why you built the portfolio in the first place. Fifth, and this is perhaps most important, I would ignore the daily noise. Stock prices fluctuate. Headlines scream about this crisis or that danger. Television personalities make dramatic predictions. Ignore all of it. Your job as an investor in crash-proof stocks is to hold on and collect your income. The businesses will take care of themselves. You do not need to manage them. You do not need to react to every piece of news. You just need patience and faith in the fundamental quality of what you own. I want to close by addressing the fear that I know many retirees feel about the stock market. The fear is legitimate. You have worked your entire life to build your savings. You cannot afford to lose it. You cannot wait 30 years for recovery like a young person can. Every dollar matters. Every decision feels consequential. But here is what I have learned in 94 years of living and 70 plus years of investing. The bigger risk is not being in the stock market. The bigger risk is being out of it. Inflation destroys cash bonds, barely keep up with price increases. Real estate is illiquid and requires management. Only stocks offer the combination of income, growth, and liquidity that retirees need. And within stocks, only crash. Proof companies like the four I have described offer the safety and reliability that anxious investors require. I have lived through 14 major market crashes. Every single time, the world seemed like it was ending. Every single time, the recovery came. Every single time, patient investors who owned quality companies were rewarded. And every single time, the investors who panicked and sold locked in losses they never recovered from. Do not be in that second group. Build a portfolio of crash-proof stocks, collect your dividends, wait patiently through whatever volatility comes, and trust that the fundamental quality of these businesses will carry you through. That is how you protect your wealth after 65. That is how you fund a dignified retirement. That is how you leave something for your children and grandchildren, not by gambling on speculative stocks or timing the market or listening to television pundits, but by owning pieces of wonderful businesses that will be worth more a decade from now than they are today, that will pay you increasing income every year, and that will survive whatever economic challenges lie ahead. These four stocks have earned my trust over a lifetime of investing. I believe they deserve yours too.